So hi everyone, welcome to today's accounting design project. We have Andrew Jackson from UNSW Business School today from Sydney to talk about the impact of diversification on industry effects in firm profitability forecasting. So Andrew, you have 1 hour and the floor is yours.
All right, thank you, Ayong, and thank you for the opportunity to present this paper. This paper is the first paper from Zongqi's PhD thesis. So I'm very happy to get some exposure for him and any comments that there are. So as Ayong said, the title of the paper is The Impact of Diversification on Industry Effects in Firm Profitability Forecasting. Now, essentially, the idea for the paper really comes from thinking about this paper from Paddy, Terry, and Sundaresh, where they essentially look at asking the question, to what level does a firm's earnings revert to? So if we think about the process of profitability, then the idea that profitability is mean reverting is a fairly well accepted sort of property. And so what they do is they essentially ask the question here, if profitability does revert to the mean, which mean does it revert to? Does it revert to the industry or the economy? And there's very good reasons theoretically why we would expect that a firm's earnings would revert to an industry level. So from a financial statement analysis perspective, we spend a lot of time thinking about industry effects, the way that a firm interacts with the industry, and the industry pressures upon a firm. And so if industry is important, then yes, we'd expect that industry being the sort of predominant factor here, it should be the case that a firm's earnings should revert to the industry level. However, it's also the case that, well, economy-wide factors are going to impact firms. And so it might be the case that, well, industry just doesn't adequately capture this process. And so a firm's earnings may revert back to the economy. And essentially what they do here is they show that on average, a firm's profitability does actually revert back to the economy. So this idea that a firm's profitability will revert back to industry means just doesn't hold on average in their sample. However, they do show that sales growth does tend towards the industry. Well, fast forward a number of years, and Schroeder and Yim come along, and they say essentially, well, this theory that Fairfield et al. Put through makes a lot of sense. However, industry-specific forecasting models may be unable to essentially capture the industry effects where we've got multiple segment firms. And so the idea behind this is very much if you've got firms who are operating across multiple segments, and those segments are in different industries, then the question really becomes, well, what industry is actually the relevant industry to think about? What industry mean should earnings or profitability revert to? And so what they do is they take a fairly simple approach here and say, well, let's just split out our sample into firms which are single segment versus those firms which are multiple segment. And what they do then is they demonstrate that the industry specific model works for single segment firms. So when you've got a firm which is just operating in a single segment, then that industry is fairly well defined. And so in this case, using an industry-specific forecasting model is able to provide more accurate forecasts of future profitability than using an economy-wide model. However, where we've got firms which are operating across multiple segments, then that underlying industry isn't particularly clear. And in those scenarios, it's going to be the case that the industry specific forecasting model just isn't able to work because what that underlying industry is just isn't clear what that should be. Now, what Zongqi is really interested in his thesis is thinking about this idea of firm diversification in a broader sort of context here. And so the first paper in his thesis is very much thinking about re-questioning this result from Fairfield et al. And Schroeder and Yim. And their starting point here is, well, simply Schroeder and Yim use a very simple dichotomous classification. Either firms are single segment or they're multiple segment. But the structure of the firm is going to be much more nuanced than just a simple single multiple segment classification. And so what we're doing in this paper then is thinking about taking this more nuanced view. And so when you've got multiple segment firms, there's going to be the degree or the idea that the amount of diversification here is potentially going to have an impact on how useful an industry versus an economy wide forecasting model is going to be. And so if we've got the case that you've got, say, a firm which has got 4 segments, if those 4 segments are very much equally sized, then yes, we don't really know what the underlying or the main industry is going to be, whereby we can actually consider what is the specific industry that the profitability should revert to. However, if you've got a single segment that dominates, then this should be a lot clearer in terms of, well, what is the actual industry that profitability should revert to? And so this is specifically what we're doing in this paper here. So we know that Schroeder and Yim say, yes, industry-specific model works for single segment firms. But no, it doesn't work in multiple segment. What we're essentially saying here is, well, Schroeder and Yim have prosecuted the case for single segment firms. Let us just focus now on the multiple segment firms. And let's think about this in a more nuanced manner here. And so we specifically take the idea that the degree of a firm's diversification should, at least theoretically, have an impact on whether an industry specific forecasting model should be more accurate than an economy-wide. Yes, Ayung.
Hi, Andrew. I think it's a good time to start because my question relates to the graph you have here, but it's in a different context. So previously, when you talk about industries, I kept thinking about in the US over the past few decades, the industry size distribution has become very skewed. So using your graph here, if you think about the upper graph and lower graph, each defines an industry. There's like very, very large firms taking a significant amount of the market share or sales revenue relative to small. So what does the literature or your paper defines the future 5 years of ROE growth? How do you kind of address that skew distribution within the industry?
So in terms of the Fairfield et al. Paper, they look at, so 5 years, but I think they also look at the 1 year ahead. What we're doing in our paper is we're just looking at 1 year ahead profitability forecasts. Now, in terms of that point about the skewness of, so some firms are going to take a larger market share than others, apart from controlling for market share in our model, we don't specifically consider that point. Now, in terms of the implications of this, if there are going to be some firms which are going to essentially be more important to the industry than others, then that doesn't necessarily mean that if you've got a smaller firm who doesn't have as much as a share of the market or that sales within that product market or industry, doesn't necessarily mean that industry won't be important if they're in that sort of bottom figure there, or that bottom diagram. So if they're predominantly still operating in that one industry, then I'm not necessarily sure that the degree of market share that they have, or lack of market share that they have, is necessarily going to impact whether that industry is more or less important for them.
So I think the literature in econ is that extended from that market share kind of skewed distribution, they find those very large firms usually are more profitable, like higher ROE, ROA, higher sales growth. That's why they continue gaining market share. So I think one robustness test is to kind of exclude, for example, the top 4 largest firms in each industry or top 90 percentile, because the rest of the firms were very unlikely to be one of those dominant firms. And in the next 1 or 2 or 5 years, right? So the average firm actually doesn't reflect any actual firms. It's just the mean between very, very large firms and then 90% of the normal firms. So if you eliminate those very dominant firms, potentially you can find your industry measure actually are more realistic for the vast majority of your sample firms.
Yeah. Now, I've got some descriptive statistics on this a little bit later, but just flicking forward and having a look at them, the sort of 99th percentile of market share is around about 25%. So it might also be the case that a lot of those, say, very large firms are potentially going to be more single segment potentially. And at the 75th percentile, it's about 1.7% of market share. So a lot of the firms that we are capturing in this multiple segment sample appear to be fairly small firms in terms of how important they are to the overall industry sales.
May I have a follow-up? I think that depends on how granular your industry classification is. When you have a very coarse one, then everyone's market share will be very small. And if you have a very granular one, then most of the antitrust lawsuits brought by DOJ and FTC is very, very granular. So they are able to identify some monopolistic power. So it's kind of like chicken and egg issues. Market share is kind of like dependent on how coarse or how granular that classification is.
Absolutely. And that's a very important sort of point to make as well when you're looking at industry effects and industry classifications, is at what level do you do this at? And I'm probably skipping ahead here, but I think it's a relevant point to be making, is in terms of if you define industry too narrowly, then there's going to be very small number of firms within an industry. And so are you essentially able to have this forecasting model that works? Then no, it's not going to be able to be, or you're just not able to capture what industry actually is. If you make it too broad, however, then who is within an industry is just going to be too wide, and it could be essentially anyone. And so what we do is, for our main analysis, we take the Pharma-French 48 industry classifications, but then for sensitivity, we do a bunch of other sort of approaches to take. So we take Pharma-French 12 industry, SIC 2-digit codes, JIGS 4-digit codes, and a Hoburg and Phillips 50 industry classification. And unsurprisingly, we do get differences across different industry classifications there, which I think precisely goes to your point there in terms of how granular or how broad do you define industry is going to potentially drive results in some instances. So just in terms of contributions, what do we argue that we add to the literature? So first of all, we do confirm the effectiveness of considering industry-specific conditions and fundamental analysis. So a lot of work that I've done looks at industry effects, idiosyncratic effects, and in teaching FSA or fundamental analysis, we spend a lot of time going through and discussing what is industry, what does industry mean? And so broadly, we contribute to that, and we confirm that, yes, industry does matter, but how you define industry and how a firm operates within an industry is going to be an important consideration as well. We do argue that we also extend this idea of Schroeder and Yim by looking at a more nuanced categorization as opposed to a simple single versus multi-segment dichotomy. And we dig into this multi-segment classification in a little bit more detail here, considering that, well, not every multiple segment firm is homogeneous. There's going to be a lot of heterogeneity across this, of which we argue diversification is one particular avenue. We further develop understanding of the appropriateness of certain benchmarks, and within a number of our cross-sectional analyses that we have added in the last week or so, we argue that, well, depending on what benchmarks you look at, is going to be, there's going to be different considerations that need to be made here. And maybe we don't do this too well, but we try to provide some evidence of how we can improve forecasting profitability in practice. One area that we are struggling with, however, is thinking about, well, how would someone who's actually trying to forecast profitability use our results in a practical manner? So we try to do a bit of cross-sectional analyses, but at what point do you consider industry-specific versus economy-wide? I don't think is one area that we have necessarily answered from a practical perspective. So any ideas people have, would love to hear about that. Now, in terms of the literature, essentially, I don't have much to talk about because we are simply adding to this discussion, essentially, that started with Fairfield et al., that Schroeder and Yim picked up upon. And so we're really looking at extending that. And in terms of our hypothesis, it's more of a research question than a hypothesis, I'd probably argue. But essentially, the question that we're interested in here is, well, what happens when we consider the level of firm diversification? So is it going to be the case that industry-specific forecasting models are going to be more accurate than an economy-wide model for less diversified firms? And if we consider this idea that, well, if you can clearly identify what the most important industry is, then firms' earnings should be reverting to that level or to that mean. And so the less diversification, the clearer it is what that main industry is. So how do we go about testing our results here? So first of all, we consider essentially 4 areas of which we're able to forecast. So we look at a return on equity, return on assets, and return on sales. Now, in terms of those 3 levels of profitability, it's pretty much similar to when we think about a DuPont analysis. So return on sales is essentially our profit margin. Return on assets is going to be essentially the profit margin adding in asset turnover. Return on equity is ROA adding in leverage. But then we also consider sales growth. And in terms of sales growth, I always think back to, and whenever I teach this, there's this quote from Richard Sloan and Russ Lundholm's book. If you could ask God for any number and fill in your spreadsheet, sales growth is that figure. And so given how fundamental sales growth is to forecast, we also consider this avenue here. Now, as I mentioned, industry classification becomes really important here. So how do you define industry is a really key consideration as well. So as I was mentioning earlier, you go to granular and you're not really able to capture what industry is in a broad sense because you get too narrow, and the number of firms that you have within that sample just becomes too small and you're not able to estimate this. You go too broad, however, and you're capturing more than just what we may consider as an industry, and you just capture too many firms within that. Now, in terms of what Schroeder and Yim do in their paper, they use a broad 12 industry classification by Farmer and French. What we do, however, is use this slightly more granular 48 industry classification for our main analysis. As I said, however, we also do a series of robustness checks thinking about the 12 industry classification, SIC 2-digit, JIGS 4-digit, and a Hoberg and Phillips measure of industry. We also exclude financial services firms, utilities, and non-classifiable industries. Financial services, they're just a bit different. Utilities, these sorts of regulated firms, harder to forecast for, and non-classifiable industries because industry just doesn't really matter. They're not really part of a specific industry. And so it's really that group of others whereby you wouldn't expect them to actually work together. Yeah, Ayung.
Yeah, I think I have like follow up on the previous thing about the industry classification or the granularities, right?
Yeah.
I'm thinking about like if you go to the extreme, each individual firm will be its own industry, right? Because it's so unique and it's the most granular. So researchers tend to already include a firm-based effect, and then that kind of like just capture each individual firm's unique business model. And the other extreme is that entire economy is one industry, so that becomes your macro, right? What's your thought on this spectrum? That's why does industry matter when we already able to put a lot of firm level dummies in the regression model?
Yeah, it's a good point. And I can go back to when I teach, and so doing case studies, it's very much, well, when you look at this firm,
yeah,
well, how do we classify a firm? I always tell students, go off, have a look at SIC codes or JIGS codes or whatever other codes that there are. So we use FactSet. FactSet has their own classification schemes as well. But then I also say, well, you're not limited to that. You can define industry how you want. So it's very much about setting what is your benchmark of firms.
yeah.
Now, in that sort of fundamental analysis perspective, it's very easy to go off and do that and say, well, look at this firm, one firm that you're following, or these 10 firms that you're following, and you've got the time, you've got the space to be able to essentially hand pick what these are. And so a number of papers go through and essentially say, well, we're not going to do this. We're going to look at this on a sort of large sample, but we're going to say these are the factors associated with improvements in forecasting. Mm-hmm. If you're going to go off and do this and hand select, these are the sorts of considerations you need to make. So things like life cycle, firm size, all these other aspects. And so it helps set a benchmarking group. Now, in this sort of design here, again, we're not necessarily saying, well, for every single firm, we're able to do this. But it's very much more of a case of, well, if you're going to go off and do this, then what are the considerations you need to make for picking what this benchmark group of firms is that you're going to be looking at here? So in that sense, we're not necessarily saying, well, we're able to do this. And so for individual firms, and so we're going to do that and then do our analysis, because on a sample of how many ever thousands of firms that we have, it's just not practical to do so. So if you like, this is very much more of a baseline sort of approach here to think about what's the better way to set a benchmark. Is it going to be within industry, or is it going to be just broader than that, just looking at across the economy? Now, I think that answers part of it. The other side is, well, at what level of granularity do we need to get here? And It's a difficult question, and it's more of a sort of empirical question, I guess. So we've used 12 versus 48 industries. Looking at, say, jigs and SIC, I can say that I ran it on, say, SIC 2-digit. I tried to run it on SIC 4-digit, but the drop in number of observations just meant that it wasn't able to work there, because in doing some of these forecasting, it requires to have, I think, 100 firms per year within the industry to be able to do the industry-specific models. So, yeah, there are sort of empirical design issues there that does inhibit that. But from a practical setting, as I was sort of saying, it's not necessarily there to say this is the most appropriate, but more in terms of if you're trying to set a benchmark, these are the sorts of considerations to be making there.
So can I have a quick kind of like summary of your answer? Is like there are many ways to pick comparable firms in the exercise of FSA or fundamental analysis. If someone decided to go with a fixed industry classification, then conditional on that purpose, your following proposed method will be applicable.
Yeah, I think that's a good summary.
Thank you.
Sudipta.
So in the US, at least, our segment data is only available for public firms.
Yes.
We don't really have any data on private firms. So, and when people do go down to the private firm level using census data and other things, they find that the classifications change a lot, right? So now, are you interested in the public firms? Are you interested in private firms? Are you interested in international firms? So what is the setting that you're going to be studying, and how comparable or generalizable are the data going to be?
Yeah, so we are looking at publicly listed US firms. So our data comes from Compustat. We use US firms only. We use all listed firms, sorry. So they could be international firms which are listed on the US. And this is very similar to what Schroeder and Yim and Fairfield et al. Have done here. It's more of a data limitation issue rather than of interest. If I had the private data available, then that would be very interesting to have a look at. But I just don't have that data available, so I can't go down to that level. Now, what does that mean? Well, it does mean that you are limited in not being able to consider the market as a whole, because yes, the market does include these private firms. Quite often private firms are more meaningful than public firms in some instances. It's just a limitation of what we're able to observe here. Now, when I teach, I quite often tell students that, look, we might have data on the publicly available firms, but doesn't mean that you shouldn't be going off to look at private firms as well.
So Compustat does include data on large private firms, specifically those that have listed bonds.
Okay.
So then the question is, are you limiting your sample to those who traded equity, or are you looking at, also those who traded debt?
So we are only looking at those with traded equity. Probably be worth going and looking at those with publicly traded debt as well to broaden it out.
Andrew, can I have a follow-up? If you are
Absolutely
thinking about including the private firms, then you are able to use a more granular industry because you are going to have more observations.
Yeah.
Rather than the industry.
Yeah.
Last time when I visited Australia, I remember there's one student, I don't remember which institution, used the Orbis data to analyze kind of like some of the private firms across different countries. So if you don't have access to the US Census data, you may check whether your institution has Vorbis. Yeah.
I'm guessing we probably do. I just haven't used it. My Zongqi can learn how to use it, maybe. Okay, so getting into how to actually apply our forecasting models. Now, this is fairly standard approach when we're looking at doing these forecasting. So we first of all have our estimation period, whereby we are estimating using 10-period rolling windows, essentially looking at the persistence of profitability. With our economy-wide model, we include all firms within the economy, within the market, which we have data for. Now, bearing in mind that we're probably going to need to go off and extend this to these private firms with tradable debt as well. But essentially looking at these persistence models, of which we're then able to take the fitted values and determine our expectation of future earnings, which we're then able to apply in the forecast period. So what we're doing is we're avoiding the look ahead bias. Yes, Adipta?
So you're using the earnings in the levels, but earnings in the levels is non-stationary. And so if you go back to Ball and Watts, you should be estimating this in changes. And then secondly, if you look at Carla Haynes' paper or my dissertation paper, in the 90s, we showed that the persistence is not symmetric. So you're also modeling a linear model when the data says it's nonlinear. So
yes, yeah. Again, a fair point. The only defense I've got against that is we are simply following what Fairfax et al. And Schroeder and Yim have done here. Completely agree with what you're saying. As I said, only defense is we're following exactly what these other two papers have done. And in terms of the industry specific, we do the same sort of approach, except that we limit this to industry. Now, what we then do is we look at the absolute forecast error for the economy-wide forecasting and the industry-specific forecasting models. We take the difference between this, and essentially we've got our forecasting improvement variable, which is essentially saying here, what is the forecasting improvement of an industry-specific relative to an economy-wide model? Now, if the industry-specific model is more accurate, then the absolute forecast error will be smaller, and so will have a positive value. If the industry-specific model is less accurate, then that's going to be greater than the economy-wide, and so it'd have a negative value there. Yes, Ayung.
Yeah. So what's the frequency of the data? You say you need 10 periods to estimate this with probably at least 100 firms in this panel. So at least kind of like one. So what's the frequency? Is it annual basis or quarterly?
So it's annual data, yes. So we're looking at annual sales growth and annual profitability. Again, this is consistent with Fairfax et al. And Schroeder and Yim.
So I think that explains that your sample is actually relatively small compared to the QuizCompustat universe, because especially after 2000, the survival rate is very low. So after 2-3 years, I think 2/3 of observations from QuizCompustat are deleted if you require firms to have been listed at least 3 years or more.
Yeah. Now, it's important to also note that we're doing this for all firms. So we're doing these estimations for combined single and multiple segment firms. However, for our later tests, we only focus on multiple segment firms. Now, I think we end up with a total sample over a period 1988 to 2022 of about 25,000 firms, 25,000 firm year observations. So compared to the total CompuStat CRISP population, yes, it is a relatively small sample that we are looking at here.
So I think the other way is kind of like there's nothing we can do with the data limitation or the nature of that firm's delisting so young. But I think will be like conditional on you survive, right?
Yes.
This will be your long run earnings level forecast.
That's right.
Okay.
Yeah.
Thank you.
In terms of firm diversification, the way we do this is we're essentially saying that we're looking at the proportion of a firm's sales, which is from its largest segment. So essentially we're saying that firm diversification is going to be sort of a negative, it's going to be negatively related to this variable largest that we're doing. So the larger the main segment is, the less diversification that we have within the firm. Now, segment data here is obtained from the CompuStat historical segment files. This data is only available from 1977 onwards. And we're also required to use the classification within these. So these are based on SIC codes for the segments. Based on that, our out-of-sample tests need to start from 1988. Now, our empirical model then, we're essentially looking at explaining this forecast improvement, and is the forecast improvement related to our measure of diversification, or largest here. Now, what we also do is we include a number of other controls. So trying to control for other aspects which are likely going to be related to the ability to forecast these firms. So we include controls for market to book, firm size, leverage, asset turnover, profit margin, accruals, volatility in earnings and cash flows, proportion of losses, the market share as sort of discussed earlier. And we also include dummies for the firm life cycle as well. We do include year fixed effects here, and we cluster our standard errors by firm. Now, in terms of our descriptive statistics, and it's also worth noting, sorry, that, as I mentioned, Schroeder and Yim have essentially litigated the case for single segment firms. Single segment firms, by definition, have no diversification. And so we're just limiting our model here to these multiple segment firms. In terms of our descriptive statistics, what we show here is that for ROE, return on assets, and future growth in sales, we actually find that on average, the forecasting improvement of the industry-specific models is actually worse than the economy-wide models. Now, is this surprising? Not really, given what we know from Schroeder and Yim, that for multiple segment firms, they argued that industry-specific models just don't work. However, we do show that there is quite a bit of variance in this, and that the percent of these which are positive, i.e. where there is more accurate industry-specific forecasts, is roughly around this 50% level. So it almost seems like it is a bit of a coin toss as to whether the industry-specific model actually is more or less meaningful for these multiple segment firms. And again, this goes to the idea that, well, the simple single versus multiple segment dichotomy doesn't pick up on this nuance within these multiple segment firms. What we do also show, however, is that for a fairly significant portion of these multiple segment firms, they are almost predominantly pseudo-segment firms in at least a quarter of the observation. So for this largest at the third quartile, we've got a value of 1. However, that is rounding, it is 0.9999 something. But predominantly, these are firms, a lot of these firms do have almost all of their sales in one single segment. But again, there is a bit of variance within this. In terms of just some simple correlations here. Sorry, Sudipta?
Yeah, so are you relying on the firm's segment reporting, or do you have some other way of verifying how many industries a firm is in?
No, so we are simply relying on what's in the Compustat historical segment file, which I'm assuming is based on what's reported by the firms in their segment reports.
Because if you're using the Hoburg Phillips, then they're using the disclosures, the 10K disclosures to classify based on product similarity. And that's not the same thing as a segment reporting.
No, and so we're not using here the Hoburg and Phillips. Later on, when we do some other cross-section, when we do one cross-sectional test, we rely on the Hoburg and Phillips vertical integration. And when we look at a Hoburg and Phillips industry classification, we're looking at these in terms of how do you put a firm as a whole into an industry, but we're not able to say, well, these segments are within those industries as well. So we're limited to saying that these segments are based on the firm's disclosures, and then however those segments are classified into SIC codes. Is it a limitation of what we're doing? Yes, but again, we don't have the ability to do anything different from that. So what do we show? Well, predominantly what we show is at a univariate level, the degree of a firm's diversification is negatively correlated with improvements in forecasting across these different models here. So ROA, ROS, and growth at a 1% level, ROE at a 5% level. However, this is sort of a baseline. We need to go in and look at this more in terms of including these other controls here. So our main results then represent, first of all, as an OLS model. So where we're simply looking at the amount of forecasting improvement. We then do a logit model where we're simply saying, is the forecasting improvement positive or negative? And so if we've got a forecasting improvement, then we're essentially saying that the industry-specific model is more accurate as opposed to the economy-wide being more accurate. Now, using our Farmer and French 48 industry classifications, what we first of all show is that the degree of diversification doesn't make a difference for forecasting improvements in ROE or ROA. However, we do show that there are forecasting improvements for return on sales and in growth in sales. So essentially what that's saying is that if you've got less diversified firms, even if they're multiple segment, then use of an industry-specific model is going to help provide more accurate forecasts for return on sales and the growth in sales. Now, what does this really mean here? Well, or in other words, is it problematic that we're not getting the results on ROA or ROE? Well, the way I sort of think about this here is in terms of, if you think about return on sales, this is going to be very much more a profit margin. So if you're trying to forecast profit margins, then the industry-specific model is going to tell you something for these less diversified firms. However, once you start getting to ROA, so you've got profit margin times asset turnover, where we know that profit margins tend to be on average much more mean reverting, but asset turnovers tend to be a lot stickier, is the fact that we've got this stickiness in asset turnover, essentially saying that, well, here the degree of, or the lack of mean reversion in asset turnover is limiting the ability of this to actually show through here. And so it's a little bit of a work in progress in trying to think through what this means here. But my initial thinking is in terms of, it's the profit margin. We know that profit margins are a lot more mean reverting. And so knowing the rate to which this mean reverts is a lot more meaningful in our forecasting. And similarly, when we look at our Logit model, again, the results hold up for return on sales and forecasting future sales growth, but not in our ROE or ROA. So this is essentially our baseline model. What we then do is we go off and say, well, let's have a think about some cross-sectional tests now. And so the first one that we've got is in terms of the changes in the accounting standards. So specifically in 1998, SFAS 131 was introduced, which changed the way in which segments were identified and reported. Now, one thing that we do show here, and so based on our total sample for both single and multiple segment firms, where we've got the forecasting improvements, we first of all go through and show that around this introduction of SFAS 131, we ended up with a lot more multiple segment firms within the sample. Now, the question here then becomes, well, do we really have an improvement in the information because firms are being able to more accurately and less prescriptively define what their segments are? Or is there essentially firms saying that they're multiple segment firms when really they're pseudo single segment firms? And does it lead to a loss of information here? Now, what do we do? Well, first of all, what we then do is we then say, well, let's split our sample on this pre-post SFAS 131 period. In panel A, we first of all just do a comparison of the means and their forecasting improvement, and simply show that there is an increase in the forecasting improvements in the post period for growth in sales, but not in any of our profitability measures. But the percentage of cases whereby the industry-specific model is more accurate increases at a 1% level for ROE and growth in sales, and quite weakly at a 10% level for return on sales. We then look at splitting out the pre and post periods for our OLS and our Logit models. We show that, again, the results only hold in that return on sales and growth. Results become much stronger for ROS in the post period. The T-stat is stronger in the post for the growth in sales, but there's no difference in that coefficient. In terms of the percentage of times whereby the industry-specific model is more accurate, we do show that in the post period for ROA, this comes through. Interestingly, though, we don't actually show any difference in the percentage in that period. So we've got no difference in this here, but it does show down here. For ROS, again, very consistent. It's very strong in the post period. Interestingly, it actually gets a little bit weak or becomes weaker in the post period for the growth in sales. So has SFAS 131 done anything here? Maybe, but it's marginal in terms of what it looks like for our results, which is quite different to what Schroeder and Yim show in their results, looking at this multi versus single segment. We then have a look at thinking about, well, what or how is a firm different in their diversification relative to their industry? So what we do here is we essentially redefine our measure of diversification by taking the industry level diversification measure, and here we include both single and multiple segment firms. And we define large diff as being the difference of the firm's diversification minus the industry year average. In doing this, again, our results only show up in terms of return on sales and the growth there. So it doesn't appear to matter how different you are from your industry in terms of diversification, the results are still holding. We then have a think about, well, does the degree of vertical integration matter? So the idea here is if you've got a firm whose different segments are operating, but they're vertically integrated, then it should be the case that the more vertical integration, the more related the segments are. And so this industry-specific model should be more important when there is less diversification. Now, how we define this is we take the Hoberg and Phillips vertical integration measure, which is, as Sudipta rightly pointed out, based around this texture analysis from the reports. But it's without actually getting into the details of the BEA input-output tables, which are quite complicated and not necessarily the easiest to map back to SIC codes. This is a simple way in which we can look at this. And so we define high versus low based on the median of this vertical integration measure. And we show that when there are high levels of vertical integration, then this industry-specific model is more relevant, the less diversified firms are. And so we argue that this is consistent with our expectations. We then think about, well, does the source of a firm's earnings matter? And so what we do here is we take based on the work that I've done with Marlene Plumley and Brian Roundtree, where we look at essentially where does a firm's earnings come from? Are they market-based, industry-based, or idiosyncratic-based? We then essentially split our sample based on the proportion of a firm's earnings, which is related back to these three levels. And then again, we just do a simple low versus high based on the median level of these. And we show that splitting our sample based on idiosyncratic earnings, there is no improvement here in the ROE or ROA. Results are slightly stronger in the high idiosyncratic firms, but not that meaningfully more. When we look at industry earnings here, and so industry, I think, is going to be more relevant because this is where essentially industry becomes more important here. For those firms which have low industry earnings, then we find that there are improvements in forecasting in ROE and ROA when there is less diversification. Now, I would have expected it to be the other way around in terms of if there's high industry earnings. So I need to do a little bit of thinking here in terms of, well, how do we actually interpret what this means? But again, in ROS and growth in sales, the results seem to hold fairly firm here. When we look at market earnings, when we've got high market earnings, then industry specific becomes more important. So the industry specific model becomes more important when we've got more or less diversified firms. And again, I probably would have expected it to go the other way here. So just need to think a little bit more carefully about what's going on again. But I think it's interesting to show this result.
Andrew, you have
Yes.
1 minute left. Yeah.
Yeah. The next thing that we do is we then look at splitting our sample based on firm life cycle. So Terry Yorn and Patrick Vorst essentially show that, well, life cycle does matter for predicting future profitability. And so we sort of pick up on this and have a look at, well, what happens if we split our sample based on the firm's life cycle? And again, we show different results across here. In the introduction stage, less diversified firms, the industry-specific model is useful in predicting ROE and growth in sales. In the growth stage, it only works in ROS and growth, as in for mature. Shakeout, diversification doesn't appear to matter at all. And in decline, doesn't matter for growth and sales, but the 3 profitability measures, it does. Now, again, what does this really mean here? Well, what we're really thinking about is, again, cross-sectionally, are there ways in which we can think about what is the most appropriate benchmark groups that we can have a look at? Sudipta.
So when you do these classifications, are you either implicitly or explicitly relying on growth in sales to make those classifications?
No, we're using the Dickinson cash flow, the signs of the operating, financing, investing cash flows to determine life cycle. So it should be, okay. So we're not relying on the growth in sales to make the classification, but is there going to be some correlation between growth and life cycle phase, or particularly I'd imagine operating, or even all 3 of them? Mm-hmm. Probably. Is that surprising, therefore, that we get the sort of result up here on growth, but not down here? No, I don't think it's surprising there. But we're not relying on growth and sales directly to determine these classifications. But in our write-up, when I rewrite the paper, very good point to point out that this is probably going to be driving this result a lot. But again, it goes to the point that, well, if we think about an appropriate benchmark, then this is what we can think about narrowing it down a little bit more. We then have a look at, say, different crisis periods. So crisis periods we define as the Black Monday, the GFC period, the COVID periods. Now, what would I expect there? Well, I wouldn't really expect there to be much improvement in those periods. We split it out into the non-crisis periods, i.e. every other year, and we get the results in those periods marginally in the ROA. Wouldn't really hang my hat on anything in this though. And then sort of getting back to a much earlier point, we've got these different alternate industry classifications. And so what we find here is that the Farmer and French 12 industry factors, we've got the results here in ROS and growth in sales, but we also find the results in ROE as well. If we look at SIC 2-digit codes, we find the results everywhere. If we look at JIGS 4-digit, and based on the number of observations, I need to go back and check whether something's gone wrong here or whether just 4-digit is too narrow in terms of the requirement of 100 observations. Either we're lacking power, probably not, just isn't showing up in jigs there. And then the Hoberg and Phillips 50 industry, which is based on, as Sudipta said, these product markets. We're not getting any results there. But again, and I think this is also related back to when these industry classifications are done, we've got a much smaller sample there as well. But basically speaking, the way we define industry does matter as well. And so maybe Farmer and French 48 is a little bit too narrow. Maybe Farmer and French 12 is too broad. Maybe SIC 2 is too broad as well. I don't think that we're necessarily able to say this is the industry classification that you should be using, but rather what we're saying is that industry classification does matter. And so if you're going through and you're trying to identify what is the most appropriate benchmark, then having a more careful consideration about what industry is the best or most appropriate to use does matter. It is an important consideration. We then also do some quantile analyses.
Hi, Andrew. We're a little bit over time now.
Yes.
You might wrap it up? Yeah, thank you.
Yep. I like these graphs. I was proud of myself for coding these, but I'll just leave that. So in summary, industry forecasting specific models, we show and we argue, do provide some improvements for multiple segment firms, but only in certain metrics and where there is a low level of diversification. So this idea that Schroeder and Em says, well, don't use it for multiple segment firms, we're saying, well, hang on, you can, but only for those less diversified firms. What level of diversification is a question we haven't yet answered, we need to think about. But firm diversification is this nuanced consideration that is important to consider. And Zhongqi, as I said at the start, is considering this in a number of other contexts across his PhD. So thank you for the time. Thank you for the opportunity, Ayung, and very much appreciate all the comments. Thank you.
Yeah. Thank you, Andrew. And then as a reminder, our next event will be on October 7th. We are going to return to the lunchtime on Eastern time. And Martin Capund from INSEAD will present the fourth quarter earnings effect. So I will stop recording.